This is our 5th Friday Fundamentals webinar on financing operational expansion. So welcome everyone to the program. My name is Philip Blackerby. My company is Blackerby Associates. I've been consulting with ADOT and their Business Engagement and Compliance Office for about 4 years now, specializing primarily in financial management, strategic planning, and marketing. Over the last 11 years, we've trained well over 800 entrepreneurs in various topics. I have a master's degree from the University of Texas and a bachelor's degree from Brown University. We have a couple of panelists with us. Roberto Valdez Beltran is marketing manager with Accion, Arizona, New Mexico. Hello, Roberto.
Hi, how are you, everyone?
Glad you're here.
Thank you for having me.
Roberto has a bachelor's degree from the Monterey Institute of Technology and a Master of Public Administration and Policy from the University of Arizona's Eller School of Business. His previous career has included work with Finca International, with Grupo Reforma, and with a news organization. He's a dual citizen of the U.S. and Mexico and fluent in Spanish. So, bienvenidos.
Gracias. Thank you for having me.
We also have Frank Beshore, president of CAFI, that's Capital Active Funding, Inc., but they generally just call it CAFI. Welcome, Frank.
Thank you.
Frank has a bachelor's degree from the University of Texas at El Paso and a master's degree from Southern Methodist University. He has previously 16 years in banking, where he rose to the position of vice president for lending at InterFirst Bank of Texas. And in 1995, he broke out of the big banking industry to create CAFI. CAFI is an asset-based lender, and we'll learn more later what that means. So altogether, Frank has about, I counted 35 years of experience in the financial industry.
You're off about a year.
Okay. Well, we're glad you're here, Frank.
Thank you.
We had anticipated having a lender from Wells Fargo, but that person has not showed up yet, so we just have Roberto and Frank here, and we're real grateful for that. So let's start off. Roberto, why don't you say a few words and tell us what Accion is and what you do in just about a minute or so?
Definitely, yes. Thank you so much for the opportunity again. Accion is actually a 501c3 nonprofit microlender, and we've been in business for 20 years. Actually, this year we're celebrating our 20th anniversary, and started our operation in Arizona in 2008 when we started expanding into the states of Arizona and Colorado, and recently just got a license to also start lending in Nevada. So we're covering those 4 states, and we do loans up to $500,000, and we lend for startups, companies, and also we do fund existing companies that are not quite bankable or are not being approved by banks. We only have 2 products, and it's term notes, which are basically conventional loans, and also lines of credit. So we can go up to $500,000 again. And
$500,000.
$500,000.
Great.
And we also do microloans. We have a subdivision that does very small loans, and usually tend to go up to $30,000. And we do require collateral for some of those loans, but we can cross-collateralize and use both personal and business assets for that. And I can, of course, go more into detail about what we ask for in order to get that secured. But we have a team of about 6 people in Arizona, full-time lenders, have served about 1,200 clients in the state of Arizona, and have lent close to $10 million for the past 6 years of operations in the state.
Great, thank you. And Frank, tell us a little bit about CAFI.
My name is Frank Beshore. I'm the president of CAFI Arizona. Well, we started our company about, actually, 1995. I'm a former banker, and the reason why I left banking to get into this business, I got tired of saying no. And that was during the good times. And the beauty about our program is we're very different from banking. We're not regulated. But we don't have the same structure as far as requirements on qualifying contractors or anybody that's out there in business. It's a very simple program. The turnaround process time as far as approval, if we have all the current documents, is typically anywhere from 24 hours to 3 days. We'll fund anywhere from $5,000 upwards of $250,000. And there have been times we've gone up to $500,000 on some invoices. But just going to tell you very simply what we do. We're an asset-based lender. You present us an invoice for receivables that you have outstanding. As long as we have some arrangement with the account debtor, the party that owes you the money, we'll inject about 80% of that invoice. And the beauty about it is it's not a loan. So when you borrow money from us, we're both waiting for payment. The payment period, unfortunately, over the years has slowed down from 30 days upwards about maybe 60 or 90. So most of you that are listening are probably experiencing this as far as slow pay. And unfortunately, it's not your fault. Because of slow pay, it puts pressure on your company. That's where we step in. So I also want to let you know we do service 3 states. We service Texas, New Mexico, and Arizona. And right now, the bulk of our business is in Arizona, mostly because the banking industry in Arizona is very pro our program. A lot of people that fund with us, some of them have bank lines. Some of them used to have bank lines. What's happened now with the criteria that the banking or the lending institutions have now, it's getting harder to get bank lines or get your lines increased regardless how much business you have. And just one big difference between the bank and our business is we're not driven by financials, whereas the banks are. We're driven by your receivable or the asset. And we specialize in construction. We'll fund janitorial, engineering companies, trucking companies, long-term health care. So any kind of contract you may have, whether it be the federal government, the state, the city, the county, and we love federal because we can go into other states all over the country. We're not limited as far as our lending territory. But just in a short scenario, that's pretty much what we do. We fill a void that the banking community does not fill. And unfortunately, the banking community is scrutinizing our credits because of the economy and plus their Fed oversight, whereas we have no oversight. So we have a lot of flexibility the banks don't have.
Great. Well, thank you.
Thank you.
So what if you knew what kind of financing would be best for you? What if you knew what kind of lender could meet your needs? What if you knew what kinds of loans are available? And what if you could get help in filling out all those loan applications and all that paperwork? And what if you could manage your own credit worthiness? Would that be valuable to you? If so, this is the right program for you. So those are some of the things we're going to cover in this program this morning. I want to point out there is a document called the Financial Services Handbook. It's about a 20-page document that goes into exquisite detail, much more detail than we're going to go into this morning, about financing, lenders, and borrowers. It also talks about insurance and bonding. It's available in both English and Spanish. So there's the long address, the URL where it is. But there's also a shortened URL. So at bit.ly/FINSBCS, and the F and the S have to be capitalized. But that's a short link to the same thing. And you can download, it's just a PDF. You can download that document for free in either English or Spanish. So I would encourage all of you to have that document. So what are the reasons to finance? There are a lot of good reasons why you should finance. Mainly they have to do with what we call leverage. So if you can improve your business if you had a little more money, that's a good reason to finance. A bad reason to finance is to meet next week's payroll, or because your revenue is gradually decreasing over time and your overhead is kind of more than you can handle. That's not a good reason to finance. That's a good reason to take another look at your business and take some management actions, but that's not about financing. So good reasons to finance include working capital, and we'll talk about working capital, what that means, but basically in most businesses you have to spend money first and then your customers will pay you later. And the difference between what you have to spend and when your customers pay you, that's the working capital that you need. It sort of bridges over the cash flow. Some businesses have cash flow peaks and valleys. Now, most of the construction-related businesses in Arizona are able to work year-round, so you don't really have so many seasonal problems. By and large, we don't have seasonal businesses here in Arizona unless you're in the retail business and you have a Christmas crush or something on that order. Business expansion is really a primary reason to finance. So if you're getting new contracts, you're growing your business, then you probably will need to finance and get some more capital. The faster you grow, the more serious are going to be your cash flow problems. The more working capital you're going to need. By definition, you're going to have to spend more money delivering products and services, and it's going to take a while before then your customers pay you back. So the faster you're growing, the more working capital you're going to need. But you may recognize that there are economies of scale. As your business grows, you don't need necessarily to add additional administrative support for your business. So you can generate more revenue, more profits without increasing your overhead. You can find new markets. You can introduce new products and new services in your offerings. You may have new locations expanding from Tucson to Phoenix or to Flagstaff or wherever you find a new location opportunity. You may need to buy real estate, an office building or a construction yard or an equipment, a place to park your equipment, to store materials, whatever. You may have major capital outlay. You may need to buy a new truck, a new backhoe, new computers, whatever kind of capital outlay. Those are all good reasons to finance your business. So, we want to focus on those good reasons that will improve your business as we go along. So there's several different types of financing. The first one we'll talk about is a line of credit. A line of credit is often set up as basically backstop protection for your checking account if you get it through a bank. You may have to manage it a little bit more closely if you get it from another kind of lender. But a line of credit usually has a ceiling on it, and you can just draw on it as you need it. You have to pay interest every month, but not principal. And it's generally a good idea, and a lot of institutions want you to pay off your line of credit at least once sometime during the year, so it doesn't become a long-term loan. It's just really to cover the ups and downs of your cash flow. So you only have to pay interest, but that interest is probably going to be a little higher than it would be with a regular loan. So you really don't want to use your line of credit for long-term financing. It's really for short-term, deal with your cash flow fluctuations. There are also government guaranteed loans. These are bank loans, but they're backed up with a government guarantee, and we'll go into some detail about those in a minute. There are also conventional bank loans, which are not government guaranteed, but banks do loan money to small businesses without a guarantee. And sometimes they're a little more expensive, sometimes they're a little cheaper. It just depends on what the market looks like at the given time that you need to borrow money. So a good banker will guide you in terms of whether a government guaranteed loan or a conventional bank loan is the best one for you at the time you're making your application. There are also accounts receivable or asset-based lenders, sometimes called factors, and Frank Bayshaw's CAFI is one of those accounts receivable financiers, and we'll talk some more detail about that. You can get financing for equipment or vehicle leases. Sometimes a lease is a better option than buying equipment because you don't necessarily have to pay back the principal. It's really kind of an interest-only type of loan. At the end of that, you have the depreciation on the vehicle that you may have accumulated, and so you may be able to buy the vehicle later at that depreciated price, and there are loans for that. In addition, there are also loans for real estate that are sort of the same kinds of loans as these equipment loans. And then there's something called a joint check. Now, technically, joint checks are not really financial vehicles. financing vehicles. But if you're a materials supplier and you have to buy materials from a broker and then provide them to a prime contractor, and you don't have the money to buy those materials from the broker, then you might be able to work a deal with the broker for a joint check. And this is an agreement between you and your supplier where when the prime contractor pays for the materials, the prime contractor issues a check in both names, both your name and the supplier's name. And so it takes both of you to endorse that check in order for either one of you to get paid. And so that sort of guarantees both parties that they will get their respective amounts of money. And so a joint check is something that you would work out with your supplier. They will basically front the materials and then get paid with a joint check later. So they get guaranteed that they will in fact get their money because you don't get paid unless they endorse the check as well. So that's something to think about if you're in the material supply business. Let's talk a minute about banks. It's important to recognize that banks are in it for the interest. They don't do risk. So a lot of people think, geez, if the banker would just take a little risk with me, well, banks just don't do risk. They do interest. And in order to make sure that they get that interest and to make sure that they get their money back, they lay down 3 different layers to ensure repayment of principal and interest. So the first thing is that they only lend when there's a sound business purpose behind the loan. So again, expanding your business could be a sound business purpose. Meeting next week's payroll is not necessarily a sound business purpose. So they expect that the business will be able to pay back the principal and the interest with the business proceeds. That is, that the profits of the business will generate enough money to service the loan. Secondly, they want collateral. And we'll talk some more about collateral, but basically they want some kind of material backup. So in case the sound business purpose idea doesn't work out, they can go collect on your collateral. Third, they're going to want a personal guarantee. So even if you have a corporation or an LLC, they're going to still ask for a personal guarantee from all of the principal owners, anybody who has more than 20% ownership in the business. So be prepared for that. Now, there is sometimes a 4th level of protection against their repayment of principal and interest, and that's the government guarantee. The government guarantee is only going to be a partial guarantee, but it does reduce any risk that the banks may have. So if the sound business purpose doesn't work out, the collateral is insufficient, the personal guarantee doesn't generate any money, then they can go and turn to the government for repayment of principal and interest. Now let's talk about collateral a second. So collateral is basically some kind of saleable value equal to the loan amount. So real estate and capital equipment can be their own collateral. So if you're buying money, if you're borrowing money to buy a piece of real estate, then that piece of real estate becomes the collateral against the loan. And if there's a problem with the loan, then they can collect, they can go seize the real estate and sell it, or seize your equipment and sell it, and use the proceeds to pay back the loan amount. Now, your accounts receivable can also be collateral. So if you have an invoice pending with your prime contractor, but the prime contractor may wait a week or 2 before he invoices, say, ADOT, the owner, and then ADOT is going to take 2 weeks, 3 weeks, sometimes 4 weeks to make their payments. Then the contractor has 7 days in which to pay you back. Most of them pay it back pretty quickly, but some of them can take a little time, and there may be some weekends or holidays involved that can get hairy. So if you don't want to wait for that, you can take your accounts receivable to somebody like Frank Bayshore here and say, Frank, I need my money right away. Can you give me that money against this account receivable? And Frank, what are you going to say?
We're going to say yes.
Go ahead.
We're doing anything we can to help them out. That's our specialty.
All right. And how much can they expect to get from that accounts receivable?
Upwards of about 80% of the face value of the invoice.
80% of the invoice.
That's correct.
Okay. And you charge a fee for this? How does that work?
The fee varies. It depends on how quick or how long it takes for us to get paid. It varies on the size and amount of the funding. And the fees are very reasonable. They're more expensive than traditional banking. But our fees are usually anywhere from maybe 2.5% to 3.96% for a 30-day period.
Okay. So almost 4% for 30 days.
Well, I don't like saying 4.
3.96, there you go.
Or less.
Or less. So it could be as low as 2.5?
Yes, you can.
Okay. So 2.5% still is around 30% annual rate?
We don't annualize it because our money turns every 30 to 45 days. So if you annualize it, it's outrageous, finance. But keep in mind, you're not financing the whole contract. You're particularly financing one particular invoice, the pay request.
And that only applies to the 80%. That interest rate only applies to the 80%.
It depends what kind of, it gets a little more complicated, but I'll say yes for now. Yes,
Okay.
it does.
Okay. So that's about account receivable lending. Your inventory can also be collateral if you maintain an inventory, if you're a supplier or you have any kind of serious inventory. Now, if possible, the lender will put a lien on your collateral, whatever that is, if they can. So if it's a vehicle, certainly they will. If it's real estate, certainly they will. There are some forms of inventory that they can put a lien on. So if they can, they will put a lien, which basically is a legal protection that says you can't sell this or dispose of this collateral without our permission. And if you do, they can come in and seize the money that generates from that sale. So expect to have some kind of lender protection on that collateral. Now at this time, for those of you who are actually located within the city of Phoenix boundaries, and particularly those who are located in certain areas of the city of Phoenix, they have available what they call the Expand program, which means that they will post some collateral for you to help you get a loan. If you have some of your collateral, they can post up to 25% of the collateral you need. Basically, they just put it up as cash, a promise to make it available if needed, and that can be as much as $150,000. So $150,000 in collateral that represents 25% of a loan value. That means it can help support a $600,000 loan maximum. So that's a real important program for those of you who are within the city of Phoenix. And if you want to contact me, we can talk more specifically about how to access the Expand program. I'm happy to help you out. A little bit more about banks. There are really kind of different classifications of banks. There's the big four: Bank of America, Chase, Citibank, Wells Fargo. Now, we don't have Citibank here in Arizona, but we do have Bank of America, Chase, and Wells Fargo. Now, these banks make lots and lots and lots of loans. I saw there that Wells Fargo alone made 859 loans in just the first 3 months of this year. $600 million worth of loans that they made that are SBA Guaranteed Loans. So those are small business loans. Bank of America and Chase are, hot on their heels. They are also very active SBA lenders, and that doesn't count the conventional loans that they made as well. They do lots of loans. They have a machine that processes the paperwork. They can give you a quick turnaround, but they have really very rigorous formulas and algorithms that decide whether you qualify for a loan or not. So there's not really any flexibility. They have pretty much hard and fast rules that they generate internally about who gets a loan and who doesn't. Community banks, on the other hand, these are some of the local banks like National Bank of Arizona, Sunshine Bank, some of these others that you see around. Biltmore Bank is really a community-level business bank. They may have multiple branches, but they really are community or sometimes regional banks. They're close to the local markets. They know what's going on in the local market. They're very competitive with the big guys. Sometimes they even have a better rate than the big guys. They can also service the loans. But the most important thing is that because they are really kind of person to person and they're right here in the community and know what's going on in the community, they can listen to your story. It's not all about formulas and algorithms. It's, tell me about your business. Why do you think this loan is a good idea for your business? What's this all about? Help me understand. And they may have a little more flexibility than the big four banks. So that's something to think about. There are also community advantage lenders. These are not-for-profit, economic development focused groups like community development corporations or CDCs. There may be microloan intermediaries, and Accion is one of those microloan intermediaries. There are community development financial institutions, CDFI. Locally here in the Phoenix area, we have Prestamos, which is a CDFI, and they're part of Chicanos por la Causa, but they are also a community advantage lender. Now, Accion, Roberto, you're not a formal SBA community advantage lender, but you are a not-for-profit, is that right?
That is correct, and we're also a CDFI.
So you are?
We have a CDFI designation, yes.
Okay. And so help me understand why somebody might turn to a community advantage lender or a not-for-profit like Accion as opposed to going to a bank.
The typical reason is you have businesses that are very young, have less than 3 years in operation, and you know, community banks actually tend to be really good referral partners for Accion because they see a lot of clients wanting to apply for loans that they don't qualify for just because of the guidelines. I mean, they tend to be a little bit more linear than larger banks, but they have some restrictions because they're also heavily regulated. The difference between them and us, the CDFI, is that we're a non-regulated financial institution. We don't take deposits, so that's the main big difference, so we don't compete. And we don't do personal loans. We just focus on the business lending. So the typical request we see is companies wanting to buy a piece of equipment or expand a little bit. They've been in business for 1 year, 2 years. They're still too young for the bank. They don't want to take the risk at that time. So they come to us. We do the loan. And we usually do short-term lending unless it's commercial real estate. So usually our typical terms vary between 36 to 60 months. That's kind of the typical term.
3 to 5 years?
3 to 5 years, yes. And we don't charge any prepayment penalty. So that's the other big thing to mention here. The reason we don't do that is because, I mean, we want to help the bankers, hopefully, you know, help their clients. And when they're ready to go to the bank, they'll be able to refinance along with the bank. So, but it's a cycle, it's a virtuous cycle. So we keep getting referrals from them. We charge fees. Of course, we charge a closing fee anywhere from 2 to 4%. You know, those are based on the loan amount that we make. But there's that advantage of not having a prepayment penalty.
I hear it.
Yep.
Great. Thank you. So when we talk about government guaranteed programs, the biggest government guarantor is the Small Business Administration, or SBA. Now they have two primary programs. On the left we show the 7A program, and on the right the 504 program. And of course those are named after different sections of the law. So 7A program, sound business reason, 504 program, strictly real estate or equipment. So if you're going for real estate or equipment, go for 504. If you're looking for cash flow financing or working capital or other kinds of loans, then you're really looking for the 7A program. 7A program is strictly a bank loan. 504 program, the bank will loan you 40% with a guarantee back to the bank of 85% of what they loan. But then they also involve a community development corporation, which puts up 50% with a 100% guarantee from the government. So, of course, that leaves another 10% that you, the borrower, has to put down. So it's a little different. It's actually two loans, but the bank and the CDC will get together and they'll figure out how to make both loans together. So it's not really that much more complicated than a regular 7A program. 7A program does have a $5 million maximum. Now, Roberto, you also have a maximum, right? What is your maximum?
Yeah, 500,000 right
500,000. Okay. So in the 7A program, there's a term. Most of them are 7 years, though if you have it less than 7 years, you can get a little break on the interest. Sometimes it goes to 10 years, depending on exactly what you're trying to finance and how you're trying to do it. With the 504 program, typically they are 10 or 20 year, but they're like mortgages against that real estate or against that equipment. Of course, you can't borrow money for longer if you're doing an equipment loan. You can't borrow money for longer than the expected useful life of the equipment. So I don't know how long a backhoe is supposed to last, but if it lasts 20 years, you may be able to get a 20-year mortgage. But a truck, you know, you may only get a 5-year loan on the truck because it's not really expected to last more than 5 years. So it just depends on what you're buying. Both kinds of loans have to be fully collateralized. And of course, the 504 is the collateral is the real estate or equipment. Both require a personal guarantee. Both have fees that you have to pay up front. And both depend on what is the cash flow of the business, what assets do the business have, what is the personal guarantee, and what is the FICO score, and we'll talk about FICO scores later. What is the FICO score of the business owners? A little bit more about the 7A program. You have to be a for-profit small business, sound business purpose. Yes, it's got collateral. There's an 85% guarantee on the first $150,000 that you borrow. There's a 75% guarantee on amounts greater than $150,000. There is a guarantee fee. That's the fee that you pay, but when you pay that fee, you don't pay any other fees to the bank. There's no legal fees. There's no underwriting fees. There's no points. There's no nothing else. It's only that one guarantee fee. There is interest. Could range from as little as 2.25% above a base level to 4.75% above that base level. So the base level is typically going to be the prime rate in the Wall Street Journal, which is currently around, what, 4%? Somewhere in that neighborhood.
Yeah.
4.5, something like that. Loan amount could be as high as $5 million, but the average loan is about $300,000 to $400,000. Maturities are 7 years, equipment 10 years, real estate maybe 25 years, and you have to make monthly principal and interest payments. There are other kinds of 7A loan types besides the basic ones. So there's what they call the cap lines, which is really more like a line of credit, and that's available. If you're in a rural area, there's a small rural lender advantage program. There's the SBA Express is really sort of their version of a very small loan, so maximum of $350,000 with a 50% guarantee. There's a special program for military and veterans who are starting up new businesses. There's a microloan program up to $50,000 through micro lenders. Now, Roberto, you were telling me that your Accion's microloans are $30,000.
Actually, we have a minimum of $1,000. It could be very small.
Okay.
But we can go up to the $500,000 range.
Oh, really?
So
even on a micro loan?
Even on a micro.
Okay, cool. And then if you are in the exporting business, there is export working capital available to you as well. 504 program. So again, as we said earlier, that's 50% loan from the bank, a 40% loan from a CDC, 10% down. You have to be a for-profit company worth less than $15 million. You have to have income of less than $5 million. You can use a 504 loan for equipment or real estate. There's an 85% guarantee on the bank loan, 100% guarantee on the CDC loan. There is a guaranteed fee. There is an interest rate, a base plus a spread. The spread will vary depending on the kind of loan it is, what it's for. So that's really a negotiated point. And a maturity of 10 to 20 years, typically. Could be longer if necessary. Now, on these CDC loans, because the Community Development Corporation really has an economic development goal here, as well as trying to lend money. So, but they have other goals they have to meet. So they have to guarantee that they create at least one job for every $65,000 that you borrow. So this is really just for business expansion. Small manufacturers have to generate one job per $100,000. There's a maximum of $5 million, except for small manufacturing, energy reduction, and alternative fuels, which can go to $5.5 million. And then there are public policy goals, which have to be addressed as well. So business district revitalization, export expansion, minority business and rural development, productivity, competitiveness. You can borrow money in order to meet federal standards if the standards have changed. Businesses owned by women and veterans are particularly favored. So there may be other goals besides just financial goals that have to be satisfied when you're dealing with a 504 program. There are 3 other government agencies that guarantee loans. There's the U.S. Department of Transportation, which has a short-term sort of line of credit up to $750,000, really for Section 8A DBEs, minorities and women. So you have to get that Section 8A certification, have to be in the HUD zone, or could be a service-disabled veteran. The U.S. Department of Agriculture, believe it or not, has business and industrial loans in rural communities. So real estate, machinery, working capital up to $10 million. There are loan-to-value ceilings. That is, they can only loan 80% or 70% or 60%, depending on what kind of loan it is. There's a 60 to 80% guarantee. There is an upfront 2% fee and a 0.25, that's 1/4% renewal fee every year. The third program is the Bureau of Indian Affairs loan guarantee, just for businesses that are 51% or more Native American owned. Can go to $5 million, a 90% guarantee, prime rate plus 1.5 to 2.75. And if you really have a difficulty, there are ways to subsidize that interest rate as well. So if you're a Native American-owned business, this could be a good option. Now, most of these applications for loans require a whole lot of documentation and paperwork that goes through it. This is a list of sort of everything you can expect that the bank will ask you for. So not just an application form, but your personal history, your financials, your personal financials, your business profit and loss statements for 3 years, written explanation of what you're doing, complete description of all ownership and affiliations. They want copies of your business licenses, including your construction license if you have one, loan application history, tax returns, resumes, on and on and on. It's a lot of paperwork. Now, Axiom, this is kind of what you're looking for as well?
Probably a third of that. not as much. We look for tax returns whenever there is a loan of $10,000 or more. We want to have a year at least of taxes. If it goes over $50,000, then we ask for 3 years as well, both personal and business, in case it's not a startup. It's an established company. We have a simple 2-page loan application, and we don't charge fees, by the way, for applicants. And if there's an existing business, again, we would like to see the year-to-date financials too. And if not, we'll look at the business plan and the projections. Now, we don't need to have a 20, 30-page business plan. We can have a good summary, 2 or 3 pages, or a good executive summary of what the business is all about. And a lot of it is based on the interview. So we want to make sure we assess the character of that interview, and we go from there.
Good. Now, Frank, I imagine your business is a lot more streamlined than that, right?
It is. Again, our turnaround time is very quick as far as approvals. We do have an application. Depending on how they're structured, if they're an LLC or a corporation, we need that documentation. We do run the credit checks. We do run lien searches. We're not driven by credit or scores. We're mainly looking to make sure that you don't have any serious tax problems or any bankruptcy issues. If you do, we can still help. You'd be surprised what we can do. I see all this paperwork reminds me of my banking days. I wear a totally different hat now. And really what we're doing is we're a short-term lender. We're not a long-term lender. In other words, most people that use us typically will stay with us anywhere from 2 to 4 years. But surprising enough, since we started this business 19 years ago, our average core business has been with us for about anywhere from 5, if you believe it, up to 14 years. And unfortunately, it's because of the banking environment and plus the economy out there.
Great. Great. Well, thank you. Now, if you're overwhelmed by that paperwork, and you very well might be, it's okay. You can get help. And so for those of you who are DBEs, the #1 source that you should look to is the ADOT Business Engagement and Compliance Office, their DBE Supportive Services Program. Now, I work for them, and you can get 3 hours of free consulting, including help putting together all that application material, just simply by emailing Kent Lane at klane@a.az.gov and tell him, Kent, I need some help. Can you get somebody? Kent will then send me an email, say, Philip, go fix this, and it's that easy. So not a problem. You can also get help from the City of Phoenix. Their Community and Economic Development Department has what they call the Management Technical Assistance, or MTA program, and they have a bunch of consultants that they can send to you, and that can be free as well. So no cost to you. Small Business Development Centers, also known as SBDCs, are all over the state. There are several in the Phoenix area. There are several in the Tucson area. There's at least one in the Flagstaff area that I know of. There are some others around the state. Typically, they are also affiliated with SCORE programs, and SCORE and the Small Business Development Centers together have consultants available, and they can help you out. They can work through these issues for you. And then if you're in Tucson, there's the Micro Business Advancement Center in Tucson, which works like an SBDC, and they can also provide free help. So all of these sources are free to you. Take advantage of them. Even if you think you can handle the application paperwork, still get involved with these people, because they can help put it together in a more organized way and make sure you've got all the dots, all the I's dotted and the T's crossed, and make sure that you get your application through the first time, and the bank doesn't have to come back to you and say, oh, I need more information. So please take advantage of these resources in one way or another. Now, they're going to look at your credit rating. So your credit rating is really, for your business credit rating, has got to do with performance on past loans. They're going to look at your borrowing compared to your income. So if you have existing debt, they're going to want to know how much that is, and compare your existing debt plus your proposed new debt against your business income. They're going to look at how much equity you have in your business, whether you've got retained earnings or not. Remember, we talked about retained earnings and equity when we talked about financial statements way back last March. And they're going to look at the Standard & Poor rating that your business has. Standard & Poor's is the standard rating agency for businesses. And even if you've never had any contact with Standard & Poor's, they may already have a rating on your business. And you can go to Standard & Poor's website and look that up to see if they have a rating on you or not. So I don't think they'll tell you what that rating is unless you pay for it, but they will tell you whether you're, within their radar or not. But, the one thing you can do to really improve your credit worthiness is to clean up your company's financials. So way back in March, we talked about Kick-Droom. I don't know if you remember what Kick-Droom is all about, but CIK means cash is king. So when your business is like your gasoline in your car, when your car runs out of gas, what happens? Your car stops dead. When your business runs out of cash, what happens? Your business stops dead. So you don't want to do that. And Droom, don't run out of money. That's real important. Don't run out of money. Now, money is sort of a bigger definition than just cash. Money can include credit cards or bank loans or account receivable loans or whatever, but it's the CEO's job to make sure that the business doesn't run out of money. So you have to keep track of all of that. Manage your accounts payable. Pay your bills on time. If you don't pay your bills on time, they'll put a ding on your credit account, and you don't want that to happen. So pay your bills on time. Manage your accounts receivable. So if you've got an expectation to receive your payment on your invoice within 30 days, don't wait 30 days. Call them up around day 20, day 22, day 25, and say, hey, just wanted to make sure you're going to pay me within the 30 days, right? You can remind them. There's not any problem with doing that, especially if you've had any issues with that payor in the past. So, I do this regularly with all of my accounts. If they're private accounts, I call them in 10 days. Say, I'm expecting payment. If it's a government account, I'll start calling them, at 25 days. Say, hey, I haven't gotten payment. I really expected it already. Can you check on it for me? You want to minimize your overhead costs, so incur no overhead before it's time. You don't necessarily need a fancy office, and you can think about using a lot of home-based businesses, or some businesses work out of executive suites, and there's nothing wrong with that. I did it for several years when I started my business. You make sure you allocate all of your direct costs to your contracts, and your indirect costs. You have to include all those indirect costs in your equipment rates when you quote. So you need to talk to an accountant. I know we've had Price Kong has given some presentations on making sure you capture all of your direct and indirect costs on your contracts with ADOT. But any good CPA will help you make sure you calculate those rates correctly. For those of you who are in professional services businesses, you need to have audited overhead rates. And if you don't know what that is, then you should learn, because that's a key way to make sure your overhead gets paid for. That's one of the things we might be able to help you out with. We can't audit those overhead rates, but we can help you establish some unaudited overhead rates as part of our 3-hour consulting project. So if you're a professional services organization, that might be something you want to do. And then important to manage projects for a quicker finish. Use your project management software and manage those projects. The faster you complete a project, the less overhead that project has to support. So the people who finish it the quickest are going to, people who finish the project the quickest are going to make more money. So all of these loans will also require a personal credit score. Everybody's going to look at your personal credit score. Frank, you look at the personal credit?
Yes, we do.
Yes, you do. And Axion?
Same, yes.
Absolutely. And a bank is going to look at your personal credit score because even if you've got a corporation or an LLC, they're going to want a personal guarantee from anybody who owns 20% or more of the business. So you've got to keep track of your personal score. Now, the FICO score is a secret algorithm that the credit bureaus use to measure your credit worthiness. FICO score ranges from a minimum of 300s to 850. Now, almost nobody has an 850 credit score. So if your credit score is not 850, don't worry about it. In most cases, you're going to need a score of around 640 or higher to borrow. Depending on who the lender is, I've never really talked to anybody that will accept less than 640. You will?
We will consider. We're a little more lenient on the credit scores only because when you're in the construction industry, most people rely on payment from the generals or the owners to make their payments on their mortgages, on their rent, etc. So it's hard for us to look very heavily on the credit scores for contractors. So we are more lenient than your typical traditional lending stores out there.
For an account receivable loan?
Yes, that's correct.
Okay.
I'd also like to comment that we have a tier-based system where actually we don't have a minimum score. We've done loans, for clients that don't have any credit. But we'd much rather see no credit than bad credit. But I got to point out that those would be very micro, small loans, maybe up to 10,000 tops. If you're looking at FICO score between 500 and 600, whenever we have a good story behind it, we're going to try to do micro loan at least if that's going to solve the problem for the client. If they are requiring more money, of course, if it's between 600 and 650, just to give an example, we might be able to go up to 30, 35,000. And again, we have to have a good story behind it and understand what happened, like foreclosures that for some reason happen, divorces, or short sale, things like that.
Stuff happens.
Correct.
So, medical.
We want to understand, yeah. And some collections like that, medical we overlook for sure. Utility bills we don't. We want to make sure that you're paying those and don't have any judgments or things like that.
Okay.
Yeah.
So the important thing is to recognize that you really have to pay attention and manage your credit score and get it as high as possible. Now your credit score there are 5 sort of primary elements that make up your credit score, and we show here the percentage of your credit score that is accounted for by each of these elements. So number 1 is your payment history. Pay your bills on time. That's the easiest way to get your credit score raised, is just pay your bills on time. That makes up more than 1/3 of your credit score. Now, it's also a question of how much money do you owe. So if you owe lots of money, your credit score goes down. If you owe relatively little money, but now they expect that you're going to owe some money. You're going to have a mortgage maybe. You're going to have car payments. You may have a couple of credit cards. And there's nothing wrong with that. It just depends on how big is that total debt against your income. And if your total debt is a whole lot, approaching what your income is, then that's going to really hurt you. And your amounts owed has to do about almost 1/3, 30% of your credit score. The length of your credit history is not a whole lot you can do about that, other than you should take out a credit card and borrow some money, use that credit card, pay it off in full every month if you can. But the longer your credit history, the better your credit score is going to be. Now, if you go out and all of a sudden create a whole bunch of new credit cards, that's going to ding you a little bit. There's only 10%, but they want you to have had credit for a long time rather than just recently. And then they want you to have a variety of types of credit. So you should have a car loan, couple of credit cards, different kinds of credit, maybe a mortgage. They want a diversity of your credit instead of just dumping everything on 2 credit cards, which are high interest. That'll hurt you a little bit.
Can I mention one thing?
You bet.
One thing we do look at are credit inquiries. And honestly, be aware when you're trying to establish credit, it hurts you more going out applying for a lot of credit, even though you're not being granted credit. And sometimes what happens, we may be the 5th company in line. Then we wonder, why did all the prior 4 companies turn you down? And that's more so in the bank than it is in our industry. So if you apply for credit, be very careful and try to minimize that. Because you're right, you mentioned dings, credit inquiries. It's going to have an impact on your credit score, but it goes beyond that. We look at credit, we look to see who you're applying credit with also.
Right. So, but you can also check on your credit, get a free credit report at www.annualcreditreport.com. Now, this is not the one they advertise on TV. That one is one of the is the product of one of these credit bureaus. This is the government-sanctioned annualcreditreport.com. Now, there are 3 credit bureaus: Equifax, Experian, and TransUnion. And you can get a free credit report once a year from each of them, which means that you can actually get a look at your credit report every 4 months. So 1 month you go to Equifax and you get your credit report from Equifax. 4 months later, then you can go to Experian, get your credit report from Experian. And then 4 months after that, you can go to TransUnion, get your annual credit report from TransUnion. Then 4 months after that, you go back to Equifax. So you can actually monitor your credit report 3 times a year by using the different credit bureaus. So we urge you to do that because they do make mistakes. So my wife and her mother actually had the same name. And when we looked at my wife's credit report, we found there were some loans that were her mother's loans that were on my wife's credit report. There were some loans from her brother that were on her credit report. Why they were on there, we don't know, but we were able to call them and get that fixed and improve her credit score as a result. So just because you may have some issues with your credit report, they do make mistakes all the time, and it's a little bit of a pain in the neck, but you can get those credit errors fixed. It may take a couple of months before you fix it, but if you get your Equifax report, you find some errors, you call Equifax, they may have you call the lender. The lender may have to send a letter to the credit bureau saying, no, this was a mistake or something, and there could be a delay in how they shuffle the paper back and forth. But eventually Equifax will fix their records. When Equifax fixes their records, they actually share data with Experian and TransUnion, and so those fixes will also eventually, after a month or two, get transferred to the other credit bureaus as well, because they all share data together. And so you don't have to deal with all 3 of them. You just deal with one of them at a time, and they'll fix the problem, and that will eventually propagate out to the others. So monitor and check your free credit report on a regular basis at annualcreditreport.com. Now, there are websites for Equifax, Experian, and TransUnion as well, and they're all www.equifax.com, Experian.com, or TransUnion.com. So those are straightforward. So again, I want to mention the Financial Services Handbook at bit.ly/FinServices with a capital F and a capital S. It's a free 20-page booklet on financing, insurance, and bonding. We will have an evaluation survey, so look for an email directing you to that survey. We'll get that out today or tomorrow. We have recorded a video of today's session. We'll post it on ADOT's website or on my own website, which is bit.ly/BlackerbyTV. Our next webinar in a month is August 8th from 9 to 10 a.m. It's going to be operational measures that tie it together. So we'll talk about measurement and managing your business according to the measures. You can register at friday-fundamentals.eventbrite.com. And I do want to remind you that one-on-one consulting is available. You can get 3 hours of my time free. Just email your request to Kent Lane, klane@az.gov. So I haven't seen any questions come up from any of the audience members. So if you have any questions, we can take just a couple of minutes and address those. But I don't see anything, but please feel free. But I definitely want to thank Roberto and Frank for coming today and joining us with this program.
Thank you. Thank you so much.
Bill, we want to thank you also for this opportunity to participate in your webinar. Thank you.
Well, I'm glad to have you here and have your great expertise available to our audience members. Thank you all very much, and we'll shut this down.